Standard credit card. This is the basic version most people picture when they think of a credit card. A bank or card company gives you a spending limit, you use the card to buy things, and then you either pay the full balance each month or carry part of it and pay interest. What makes it different is its simplicity. There are usually no special categories, no travel systems, and no major perks beyond the ability to borrow for short periods. It matters because this is the foundation of the whole credit card system. For many people, it is the first step into building credit history and learning how revolving debt works. Cashback credit card. A cashback card is one of the easiest reward cards to understand because it gives back a percentage of what you spend as cash or statement credit. Some cards offer the same rate on everything, while others give extra cash back on categories like groceries, fuel, or dining. Its appeal comes from being practical. You do not have to learn a point system or search for special redemptions. It matters because for many households, this is the most useful type of card in everyday life. The value is clear, direct, and easy to compare. Travel credit card. A travel card is built for people who spend on flights, hotels, or other travel-related costs. Instead of simple cashback, it often gives points or miles that can be used for trips, upgrades, or travel credits. Many of these cards also include benefits like travel insurance, airport lounge access, or no foreign transaction fees. What makes them different is that the rewards are tied to movement and mobility rather than ordinary cash value. They matter because they can be very valuable for frequent travelers, though the real benefit depends on how often the cardholder actually travels. Balance transfer credit card. A balance transfer card is designed to move debt from one card to another, usually with a temporary low or 0% interest rate. The goal is not better rewards or better perks. The goal is breathing room. This type of card became important as credit card debt grew, and lenders found ways to attract borrowers carrying expensive balances elsewhere. What makes it different is that it is mainly a debt management tool. It matters because it can help someone pay down debt faster, though transfer fees and the return of normal interest rates later still need careful attention. Low-interest credit card. A low-interest card keeps borrowing costs lower than usual, either all the time or for a promotional period. It is aimed at people who may sometimes carry a balance and want to reduce how much interest builds up. Unlike flashy reward cards, these cards focus less on perks and more on cost control. That matters because many people choose cards for benefits but end up paying heavily when they cannot clear the full balance. In that situation, a lower rate can be more valuable than any reward. Secured credit card. A secured card requires a cash deposit before you can use it. That deposit usually acts as collateral and often sets the size of your credit limit. This type of card exists mainly for people with limited credit history or damaged credit who need a way back into the system. What makes it different is that the lender takes less risk because there is money behind the account. It matters because it can help someone build or rebuild credit when other options are not available, provided the card is used responsibly and payments are made on time. Student credit card. A student card is made for people who are new to credit, often while they are in college or university. These cards usually have easier approval standards, lower limits, and simple rewards. Their purpose is not to offer luxury benefits. It is to introduce young adults to borrowing, billing cycles, and credit scores. They matter because early habits tend to last. A student card used well can help create a strong credit record, while misuse can create problems right at the beginning of adult financial life. Business credit card. A business card is meant for company expenses rather than personal spending. It can be used by sole traders, freelancers, startups, or larger firms, and it often includes tools for tracking expenses, employee spending, and accounting. What makes it different is that it sits between payment tool and business management tool. Historically, these cards became more important as companies wanted cleaner separation between work and personal finances. They matter because they can simplify bookkeeping, improve cash flow, and sometimes offer rewards tailored to travel, advertising, or office costs. Charge card. A charge card looks like a credit card, but it works differently. Instead of allowing a revolving balance month after month, it usually requires the full balance to be paid on time each billing cycle. In earlier decades, charge cards were often associated with status and expense account spending, especially in business and travel. What makes them different is that they are built for short-term convenience, not ongoing borrowing. They matter because they encourage disciplined repayment, though missing a payment can have serious consequences. Store credit card. A store card is offered by a retailer and is mainly intended for use in that shop or retail group. In return, it may offer discounts, promotional financing, or loyalty rewards. These cards became common as stores looked for ways to encourage repeat spending and keep customers inside their own brand ecosystem. What makes them different is how narrow they are. They matter because they can be useful for regular shoppers, but they often come with high interest rates and can tempt people to spend more just to get a discount. Premium credit card. A premium card sits at the high end of the market. It usually comes with a higher annual fee and in return offers richer rewards, stronger travel benefits, concierge services, lounge access, insurance protections, and other extras. These cards are designed to feel less like a simple payment method and more like a membership product. What makes them different is the combination of cost, exclusivity, and bundled benefits. They matter because they can provide genuine value for heavy spenders or frequent travelers, but only when the benefits are actually used enough to justify the fee. No annual fee credit card. A no annual fee card removes one of the most visible costs of card ownership. You can keep the account open year after year without paying just to hold it, which makes it appealing for long-term use. Some of these cards still offer rewards, while others stay basic. What makes them different is not a special reward system, but the absence of a yearly charge. That matters because keeping an older account open can help credit history, and doing that without a fee is often financially sensible. Subprime credit card. A subprime card is aimed at people with poor credit who may not qualify for better options. These cards often come with high interest rates, extra fees, and low credit limits because the lender sees the borrower as risky. They grew as parts of the financial industry looked for ways to serve and profit from customers outside the prime lending market. What makes them different is the cost structure. They matter because they may offer access when choices are limited, but they can also trap people in expensive debt if used carelessly.